Hello everyone, welcome and thanks for watching the Market Report. Happy 4th of July for those in the United States. I'm your host Marcel Pechman, analyst and writer at Cointelegraph. The show debates the most pressing topics impacting the crypto market, focused on price changes and meaningful events. First article was written by Turner Wright. BlackRock spot Bitcoin ETF filing names Coinbase as surveillance sharing partner. The application includes a Nasdaq Coinbase agreement intended to supplement the exchange market surveillance program, following the SEC reportedly saying the filing was unclear. Some analysts have been signaling those ETF proposal changes are responsible for the bull run towards $31,000, and they are partially correct. However, is that sustainable? That's the million Satoshis question, and we'll analyze the scenario right now. So, what happened here? Why so many Bitcoin spot ETF proposals suddenly changed to include Coinbase? Well, the regulator told them that some of those were not sufficiently clear and comprehensive and suggested adding more details on the surveillance agreements. It basically means that the ETF fund managers have to designate how the theoretical price formation occurs. As you all know, there's no official Bitcoin price index, and the SEC, the regulator, will never accept something that's mostly based on unregulated stablecoins trading, namely Tether. That's why the ETF proposals rushed to name Coinbase Exchange, the leading US exchange in spot volumes in US dollar, to be the official price maker. But that does not mean that the SEC will accept that, given that we all know how much larger the volume is outside of the United States, even though the ETF should not account for that, given that they are not traded in US dollars at Binance, OKX, and Bybit. So basically, we're stuck at a regulatory hurdle. Should gold market account for the trading taking place near the mining fields? Should the oil price account for the undocumented extraction in Russia and Africa? Who's going to be responsible to analyze and judge this volume outside of the regulated exchange in the US? Maybe what needs to happen in that case is a court decision, like going to justice. The SEC must explain what is the rule for the remaining spot ETF markets, such as gold and oil, and let the judge decide if the same methodology was applied for Bitcoin. We all know how anti-crypto the current SEC team led by Gary Gensler has been. So, are they using two different metrics for different markets? Because that would not be fair. And in my opinion, it is exactly what's happening right now, because they don't care about the oil prices or the gold prices formation outside of the US regulated exchanges. So why should they care at what price it's trading at OKX or Binance in Tether terms or whatever stablecoin they're using there? That's not what the ETF spot Bitcoin ETF price formation in the US should account for. I cannot say with 100% conviction on what the SEC should be using as a metric. I just want them to be explicit and show how it's used on other markets so we can compare to what's been said and analyzed when considering the Bitcoin spot ETF approval. Okay, and what about the Bitcoin rally towards $31,000? Is it justified? Sure. There's no reason to bet against BlackRock and Fidelity. Those are the world's largest asset managers, so a mere 1% or 2% allocation for their commodities exposure represents billions and billions of dollars. However, given the history of multiple consecutive rejections and the two main complaints from the regulators, namely the wash trading and the price making happening on Tether-based exchanges, one should not give a 60 or 70% probability of approval within 12 months. My point is, it should be much lower than this, maybe 20, 30, 40%, but not higher than this. The conclusion, the feeling change, naming Coinbase as the price-making venue is an excellent start for a court battle that might take a couple of years. If prior to that, the odds of a spot ETF approval within 12 months were 10%, they should now be increased to 30%, given the relevance of BlackRock and Fidelity in the ETF world. Consequently, the $31,000 price support for Bitcoin remains at risk in my view due to macroeconomic uncertainties, namely the potential economic crisis and weak stock market performance, and the harsh regulatory environment towards cryptos, especially in the US. So, in my opinion, we're not yet in a full-blown bull run. Now, on to the next topic. We'll cover an article by Brian Lindrea. Winklevoss slams DCG's Silbert. Not even SBF, Sam from FTX, was capable of such delusion. In an open letter, Cameron Winklevoss slammed DCG's Barry Silbert for allegedly playing the victim card while owning $1.2 billion to Gemini's 232,000 earned customers. If you are unfamiliar with the case, Gemini Exchange had an yield program called Earn, except instead of investing themselves, the Facebook brothers had a great idea of handing the money to the shady Genesis Trading Company, which is owned by DCG Group. It turns out that Genesis itself was investing in Ponzi schemes, or at least providing loans for them in return for a potential interest rate, which is basically the same. So, as Three Arrows Capital and alike went bankrupt, so did Genesis. Now, DCG Group owned $1.2 billion to Gemini. So who's the thief? Who's the victim? Well, in my opinion, they're all in this together. Gemini isn't the 70-year-old grandmother living in Arkansas. They knew very well how risky the investment was and didn't care to run a due diligence. Stating that they have been fooled by Barry Silbert seems kind of naive. Did Barry Silbert commit crimes as stated by the Facebook brothers' open letter? Most definitely. Even if it's not considered a crime, it was unethical and unfair to cover up the losses using intercompany loans, which he knew were unsustainable from the start. I'm not a judge and have no insider information on the case, but from what's been said on the media, DCG and Barry Silbert are in troubled waters. Okay, and what does Bitcoin and crypto markets have to do with this? Now comes the fun part. DCG owns another company called Grayscale, which happens to manage the Bitcoin Trust, a tradable investment fund worth $19 billion of Bitcoin, besides a similar instrument for Ether holding $6 billion. I'm not saying they'll be forced to market sell those, because the fund manager does not own those shares of equivalent Bitcoin and Ether, but DCG owns some of it. Besides, in the eventual liquidation or forced sale of Grayscale, there's a small chance that a new fund manager will decide to liquidate the funds and somehow return the money to investors. The problem is, none of that makes sense. Grayscale is a cash call. They collect 2% fee no matter what, and the investor has no way of exiting their Bitcoin and Ether trust. So, in my view, the market greatly exaggerates the risk of Grayscale asset manager being sold. Yes, it exists. There's the risk that the court will decide that the content funds must be sold, the fund must be liquidated, or the buyer of this fund says, I don't care, I don't want to run the risk, let's liquidate the assets and give the money back to investors. So it exists. I don't know if it's 1%, 5%, 10% odds, but it's something to be considered. So that's a risk for those betting that Bitcoin will never trade below $31,000 or $30,000, because there's a probability even if it's small, that Grayscale's BTC and Ether funds will be liquidated, and no one knows what the 25 billion sell order can cause to those markets. That also explains why I'm not completely convinced that we've entered a bull market. Just to highlight, that's my own opinion and it does not constitute investment advice or reflect Cointelegraph's official view. Well, that's it for today. Hope you guys enjoyed the show. Don't forget to visit Markets Pro, the professional Cointelegraph alerts platform. Our proprietary indicators have been giving profitable alerts for months. There's a 20% discount link in the video's description. See you!